Hi, Dominique, and welcome to another edition of The Week Ahead. How are you doing?
Very well. Thank you, Andrew. How are you? It's nice
Uh,
to see you so summery. And
yes, thank you. It's been later, I guess, than we normally. And it's been cloudy, a little bit rainy today, but it's all good. It's still pretty warm, so it's nice in summer. As we always like to do, let's kind of dig into the previous week. I was just kind of looking on Bloomberg. The U.S. equities were pretty flat, actually, but European equities had a pretty rough week. Not sure what to take of that. Obviously, the big driver, I guess, over the past week has been the Dominique effect of fixed income continuing to sell off. I'm more just kind of looking at the 10-year pretty uniformly, I would say, across markets, Canada probably being the worst. And then a currency-wide, surprisingly, with the fact that U.S. spreads yields were going higher, actually yen was one of the best performing currencies. And then Kiwi as well, which kind of fits into, I know, our view or kind of Ben's view about kind of bearish Aussie Kiwi, proving to be a good idea. So yeah, what was your kind of big takeaways? Obviously, a lot of data came out, Fed minutes and other big things, and kind of what was your interpretation?
my interpretation is that things more or less followed the first law of economics. What goes up must come down. Joke apart, we had a bit of a roller coaster on the US labor market, with people getting very worked up over the ADP number. And then for the first time since April of last year, the NFP was below expectation, not by much. So when you have all this noise and agitation going on, it's important to keep your eyes on the big picture. And there's a big picture, for all the volatility and all my silly jokes wasn't changed that much, basically.
Right.
Labor demand is slowing. The growth is slowing because it's slowing from unsustainable levels, but it's not slowing fast enough that labor market tensions are easing. So that's basically what I wrote in my NFP review, which will be out on Monday. I looked at things like temporary employment that's going down. But actually what's going on here is that there are structural changes in the labor market in the US. Like, for instance, the share of full-time employment is the highest in 20 years. And so employers are relying less on temporary work simply because they can't find enough workers. And so they would rather give them good working conditions like full-time jobs and rely less on part-time. So I'm getting into the weeds here, but the bottom is I try to address my many critics, or at least people who have a different perspective from mine. I really try to do a deep dive on the data, and I'm finding that it's still the same story.
So if it's a higher percentage, or people are more comfortable with hiring permanent positions, then, there could be some switching between, like things like, I guess, Uber, like more kind of gig workers. But generally, it means employers are fairly confident.
Exactly.
And want to make sure, this, I guess there's a little bit of hoarding, but there's also obviously a little bit of hoarding employees, but there's also a comfortability that things are okay for the foreseeable future to hire permanent.
And also, in my view, it's a sign of the post-pandemic macro backdrop, which is going to be more inflationary because workers have a bigger market power. There are fewer of them. If you look, that's one thing that's fascinating. If you look at participation rate or the employment to population ratio, It's actually very high for the prime age group. So the people who are no longer in the workplace are older workers, but for prime age, it's the highest in nearly 20 years.
I was
So
going to ask you about that because I was really surprised to see that, because everyone says, oh, the great resignation and all this stuff, but it's prime 25 to 55 is actually participation rate is like super high. It's
exactly.
people either they're sick or they have enough money to save, or they have enough money to save and making a existential decision that it's more enjoyable to relax than whatever work more. And then I guess younger
Obviously,
people.
they are not working at Macro Hive. If they were, they would not have worked out. I'm joking here, but for people who are in less interesting jobs, who are older, as you said, who have stashed enough
I like
money
it.
aside, sure. I mean, and these people are not coming back. But what I was trying here is that this increase in full-time job as a share of total job, which again is a reversal of 30 years of decrease, could very well reflect stronger workers' bargaining power, so stronger structural increase in the share of workers' income, in total income, and potentially more inflation because employers are going to try to protect their profit margin by passing on the wage increases, certainly when the economy is as strong as it is now. So that was an interesting story coming out of this NFP report.
Right. So, yeah, just to finish on the NFP. So your takeaway was it's slowing, but nowhere near. I think you were shared something with me. Even like City Surprise Index is still gone up a lot. The Atlanta Fed is a little bit slower, but still like relatively above what the Federal Reserve would assume is even trend the U.S. economy at this point, which is amazing considering they've raised rates by 500 basis points. So, and it did, I don't want to spoil the end, but it fits into your kind of narrative that there may be pain to come, but it's still several months away. Pain like rates are high enough, like it really is going to be negative. So you still feel like the general backdrop and the approach of the Fed towards the economy at this point should be actually continue to be fairly positive for risk.
Oh, totally. I mean, this doesn't change anything. First of all, the Fed doesn't like to react to single data points. And also, once you do a deep dive on the data, actually, it still paints a picture of a strong labor market. So the 2 rate hikes, in my view, are still on. We have a good number of Fed speakers next week. That's probably what they are going to say. Maybe not Bostic, but the other guys, Mester, Kashkari, they'll certainly, allude this
Hawkish, proud. Yeah.
So no, we'd had 14 consecutive months of positive NFP surprise. We were due for a negative surprise. We got it, but other than that, there is not much new that was really new in the data.
And generally, the numbers are above what they were before anyway.
Oh, I mean, sure. I mean, if you look at unemployment, it was down. If you look at the employment to population ratio, the prime age, as we discussed, it jumped up from a very high level. No, really, this is not an economy that is slowing, not at all.
Yep. Okay. So for the week ahead, what do you see? I mean, obviously now we're really hitting the stride of like the center of the summer. First, I guess, which probably all our clients, investors want to know, do you see any potential surprises in the upcoming week?
Not really. I mean, this is a CPI week. It's not so much the aggregate data. So the number for core month-on-month, but the split between Powell's three components. And I think we're going to continue to see sustained shelter and services ex shelter inflation. Maybe a little bit of excitement with used car prices, as I was joking about the first law of economics, but it's only half a silly joke. It's been quite volatile. Is it a big deal? Probably not.
Right.
So, yeah, I think our clients are enjoying a well-deserved rest. I hope they don't interrupt their holidays to look at the detail of this CPI data.
Right.
I mean,
just one question on the used car prices.
Yeah.
Now, what is kind of like the driver? Is the spread between used car and new cars tightened enough? Like, is it back to 2019? And is it like a point of affordability? Is it a point of interest rates? Is it a point of supply chain issues? Have all those things been relatively kind of priced in or sorted?
It's affordability, really. I think Cox Automotive and S&P or Moody's have a car affordability index, and it's just like house affordability. It's plummeted. In the case of cars, it's because manufacturers are producing ever nicer cars with more bells and whistles, and because the CPI has this adjustment for quality, the new car price index in the CPI actually doesn't convey the lack of affordability for average families. And so everybody is buying secondhand since new is less affordable. So the spread between the two is narrowing, though it's the spread jumped during the pandemic because there were really no cars to be bought, so no new cars. So people paid absurd prices for used car, and there is a bit of a normalization going on. But the bottom line is that we're going to see used car inflation from 2 or 3 months ago, deflation. Is it going to change the picture? Not really.
Right.
But
do you see anything? I saw some stories about, I guess these are kind of national dealerships that are going under for, like, is this have an impact on supply? Is it having, well, I guess the result would be maybe forced selling, so more supply coming on the market.
So at the moment, there is a buildup of inventories at dealers, so it remains well before pre-pandemic. Also, manufacturers have started to produce less expensive cars, expensive unadjusted for quality. And there is a long-term question on dealership because during the pandemic, manufacturer had the opportunity of experiencing sales with much fewer leaner inventories. And I think they are watching Tesla with some envy, as you know. There are no Tesla dealership. You just walk into a shop. So it's a much cheaper and leaner distribution system. So for sure, traditional car manufacturers who are getting into EVs are probably having second thoughts. On the other hand, it's not easy to, get rid of all your dealers when you've worked with them for, forever. So.
And what percentage of CPI is used cars?
Oh, it's very small.
Okay.
Yeah.
Okay, cool. Anything else that people? We got CPI, we got some Fed speakers, which most of them will probably be hawkish, or at least leading towards 25 basis point hike in the next meeting. Anything else? Yeah.
So we'll have the small business survey, and I think it will once more show that credit availability is not an issue for small business, or not a worse issue. That their main constraint is not credit, it's more the cost of input and being able to find enough workers. We're going to get the Fed consumer credit report, which will show that, there isn't a lot of extra demand for credit here. I guess we'll get the University of Michigan consumer confidence, and this one I'll be looking at the data for long-term inflation expectations because it's been moving.
Moving higher.
Moving higher, slowly but surely, which is hardly surprising because inflation has been above 2% since the middle of 2021. So, of course, jobless claims, and there again, not much going on. There was a little bit of a cycle which got people excited. They thought the labor market was weakening, but this is actually really low quality data. Import price and PPI, not much going on there. And then we'll get the June federal government budget balance, which will show that it's getting worse. I think interesting little pieces of information, but nothing to get people to interrupt their holidays or
and
so.
Budget balance because receipts are coming in lower than expected, because spending is higher.
Both actually.
Perfect.
Receipt is a big issue, and it's extraordinary that we should have a budget deficit of 8 percentage points of GDP.
Insane.
When the economy is so strong, it's complete. Yeah, insane is a word.
Agreed with that. Okay, awesome. So as we kind of always like to do at the end, kind of highlight a few of the interesting articles that we've had this week. So one I was looking at was Ben's piece on when to fade your stocky. I think Ben and the team have had a great call on kind of positioning for a weak stocky for a long time. And so now the question is that, when is the time to actually look to fade that? And that is kind of a very interesting piece and actually a pretty cool takeaway, definitely worth reading. In the Rates Weekly, something we've been talking about for a long time, I know you and Mustafa, is the narrowing of NIM. So, what kind of interest rate spreads can banks take, or are able to take advantage of, and we're starting to see that narrowing. So right now we don't see that as resulting in a massive impact on the U.S. economy, but that's probably a good one to watch. And people were predicting that 4 or 5 months ago. We weren't really seeing those numbers. We're starting to see that now. And then the third piece was this from this person, Dominique, your piece, as we discuss about why, everyone thinks you're so bearish all the time because on risk, because, of your view that it's going to be much harder to bring down inflation than probably like 98% of the other people in the market. But that hasn't been your view. Your view is, yes, inflation will be much more difficult. That we agree. But the idea that you're, super doom and gloom all the time is actually not true. You've been pretty bullish on risk for a while, and it's really predicated upon not being in the recession camp, and
the Fed,
and in the inflation, the Fed is going to be overly dovish, or much less hawkish than everyone kind of paints it out. And I guess, but I was going to say the third part is your view is inflation is not coming down, but it's, for now at least, it's at least stable. So if you have those three pieces together, it's probably good for risk. Is that correct?
Yeah, that's correct. And look at break-evens; they're not going anywhere. So the market has enormous trust in the Fed ability to bring down inflation without damaging the economy. And as long as this trust has not been tested, happy days.
Yeah. Yeah. It's really been quite a journey from all the pushback that that you've gotten, I would say, over the last 16 months. And all the kind of the worries about recession or the confidence inflation was going to come down easily over the last 16 months, maybe longer, 17 months. It's been amazing. You've been pretty steadfast in your view, and clearly it's been proving to be right. So
I'll change my view when the data changes.
exactly. So, okay, cool. Thank you again, and wish everyone, a wonderful week this week. And as I know you always like to say, please reach out to us with any thoughts, any pushback on certainly on any of your views. Any other parting words for all our kind of clients, investors?
No, I just hope everybody has a restful and enjoyable summer.
Awesome. Thanks.